Hi everyone, welcome to a brand new episode. My name is Marcus and today we're looking at Twitter. We'll cover the income statement, balance sheet, cash flow, key figures, our key feature, and the technical analysis of the stock. Should we be buying the stock right now? Let's find out. So, Elon Musk just became the largest shareholder of Twitter. And what does it mean? Is this a fight for free speech, or is it an attempt to drive the stock price higher? Or maybe will he have a profound impact on the business? Should we all now be buying the stock? So you may have heard the news of Elon Musk becoming the largest shareholder of Twitter, having 9% of the company by having almost 74 million shares worth approximately $2.9 billion. That means that he has more shares than the co-founder and former CEO Jack Dorsey. Elon Musk is not shy when it comes to questioning the company. He had a poll recently about the free speech where he asked his followers if Twitter adheres to the principles of free speech. 70% of voters voted no, and Elon Musk tweeted that answering the poll could have consequences. So is this what we are seeing right now? What are the reasoning behind his purchase? I would love to know what you guys think. Please let me know in the comment section below. So Twitter is a global platform for public self-expression and conversation in real time. Basically, they are helping people discover, consume topics and events the user cares about. And Twitter makes their revenue through promoted ads. And with that said, let's look at the numbers. Twitter is traded on New York Stock Exchange and are in the technology sector. If you go down to the screen, we can see that their market capitalization coming in at $31.5 billion and their revenue is at $5 billion. Now, we don't have any PE data, but I want you guys to know that when you see a stock with a high PE data, what does it tell you? It tells you that the market expectation of the stock is high, and therefore you might see capital gains on those stocks because there is a lot of investors coming in and pushing the price even higher because they are expecting better and better numbers. But the overhanging risk, as we have seen with Netflix, PayPal, Facebook, is that if the company doesn't meet those expectations, we see the stock price fall. Same thing goes when you see a stock with a low PE ratio. That tells you that the market expectation of that stock is low, and therefore you might not see capital gains of those stocks because the market doesn't expect much of those stocks. But if we look at the profit margin is at negative 4%. I like companies with a profit margin of 15% or higher. So coming in at negative 4%, that is just too low for me. So that is a no. Price to sales ratio coming in at 6. Normally, I like companies with a price to sales ratio of maximum 4. So I understand 6 is not far from the threshold. I understand if you want to be flexible, but for my case, it's higher than what I normally like to take a look at. So that is a no for me. Price to book value coming in at 4. Normally, I like companies with a price to book value of maximum 3. So I understand 4.4 is not far from the threshold. I still understand if you want to be flexible, I get it. But for my case, that is too high for me. So that is a no. So if we were to summarize, we currently don't have any PE data, but the price to sales ratio is too high and the price to book value is also too high. That tells me that Twitter at its current state is overvalued. Now, they don't pay out any dividend because and that is a shame because you guys know that I like those recurrent income. And return on equity coming in at negative 2.9%. That is a no for me. So basically, return on equity tells you about the company's ability to create return on their equity. And as for investor, that means their ability to create return on the capital you bought to invest in them. So make sure you have a company with a positive return on equity. So coming in at negative 2.9, that is a no for me. Return on assets is at 1.2%. That is very low, but looking at the negative return on equity, a positive return on assets, that is a plus. So I'll like that. So that is a go for me. So the stock is currently traded at $50 per share. And if we go down to the moving average, we can see that we are above the 50-day moving average, but below the 200-day moving average. So what is this telling us? Well, it's telling us that there is uncertainty here. The signal doesn't tell us whether we'll see the stock price increase increase or whether it will decrease. But if we take a quick glance on the chart, we can see that we have been moving in a positive trend channel here. But if we zoom back a bit, we can see that we have more or less been consolidating before the price broke down in a negative trend channel. But lately we've seen a counter trend, and then we saw this jump because of Elon Musk buying shares in the company. But we'll take a closer look at the technical aspect of the stock further down. But let's jump over to the income statement. And what we can see here is that the total revenue went from $2.4 billion in 2017 up to $5.1 billion in 2021. And these numbers have been improving every year. That is a plus. I like it. Gross profit went from $1.6 billion up to $3.3 billion, and these numbers have been improving every year. That is a plus. I like that. Net income went from negative $108 million down to negative $221 million, and we can see here that these numbers improve a couple of years, but has of lately seen lower and lower numbers. So we're seeing a counter trend right here. So this is negative. Now let's jump over to the balance sheet. What we can see here is that what we're interested here is that the current assets versus the current liabilities, and we can see there's a huge difference between the current assets and the current liabilities. Basically, what it's telling us is that if the company were to convert these assets to cash, they're able to pay off their current liabilities and still have a lot of capital left on the table. And that is huge. That is a plus. I like it. But also, they are able to pay off the total liability. And that is just amazing. So imagine being able to pay off your mortgage, your car loan, your student debt, and your consumer debt, everything, and still have $1.1 billion in cash left on the table. That is just huge. That is a plus. I like that. If we take a look at the total liabilities, we can see that it went from $2.4 billion up to $6.8 billion. And these numbers have been growing steadily every year. That is negative. I would like to see them start reducing the total liabilities, also reduce the rate which the total liabilities is growing. Now let's jump over to the outstanding share. And we can see here we went from 746 million shares up to 799 million shares. And these numbers have been growing over the past 5 years. That is negative. So what is happening here? When we see these numbers increase, that means that the company is issuing shares, meaning that there are more and more available shares out there, making your share of the company decrease, meaning that you're being diluted as investor. If we were to see this number decrease, that means that the company is buying back shares, and meaning that there are fewer and fewer available shares out there, making your share of the company grow, expand. So, and I always say this, there's a lot of investors that either skip this part or doesn't know about it because they've been looking at a company's balance sheet, and for instance, they see a company with a strong balance sheet that has a lot of assets and the debt is not growing that much, which is positive, which is what everybody's been looking for. But on the other hand, we see that the company is issuing more and more shares, and that is negative. But at the same time, I want you to know is that that's a way for a company to bring in more capital without taking on more debt. So don't get blinded by just looking at the assets and the debt. You see, well, this is great, but on the other hand, they're issuing more and more shares, and that is negative. Now let's jump over to the cash flow. And what we're interested in here is that the operating cash flow versus the capital expenditure. And we can see here the operating cash flow came in at 632 million and the capital expenditure at 1 billion, making it a difference of negative 400 million. So that is negative. We can see here the operating cash flow went from 831 million and went down to 631, and we can see that these numbers have been improving, but has of lately seen lower and lower numbers. So that is negative. Capital expenditure went from 160 million shares up $160 million up to 1 billion, and these numbers have been growing steadily every year. That is a plus. Now they need to improve their operating cash flow, but at the same time, I like the fact that they continue to invest in the business. The capital expenditure is growing, but they need to find ways to improve the operating cash flow. Now let's jump over to the key figures, and what we can see here is that the earnings per share went from negative 14 cents up down to negative 28 cents, and we can see that these numbers improved a couple of years, but has of lately seen a downtrend, so seeing a negative number. So this is negative. Revenue per share went from $3.27 up to $6.35, and these numbers have been improving every year. That is a plus. I like that. Equity per share went from $6.7 per share up to $9 per share, and these numbers have been improving. We fell off a bit a couple of years here, and these are negative, so that is minus. They don't pay out any dividends, which is a shame, because I like those recurring income, and also I like companies that increase the income every year. So seeing that they don't pay out, that is negative. Gross margin went from 64.7% down to 64.6%, and we can see that these numbers improved a bit, but have since seen lower and lower numbers. That is negative. So they need to find ways to become a more efficient. I also would like to see more stable numbers, a stable development, and seeing that there is a lot of fluctuation here, but at the same time that these numbers are getting lower and lower. So meaning that the cost of goods sold is increasing. But at the same time, we need to compare these numbers across the industry and see how is Twitter doing compared to their competitors. Now the operating margin went from negative 3.9% down to negative 8%, and we can see they improved a bit, but has since seen lower and lower numbers. This is negative. Profit margin went from negative 4.4% up to negative 4.3%, a bit of improvement, but we can see here they improved a couple of years, but have of lately seen a negative trend, that is minus. Return on equity went from negative 2% down to negative 3%. We can see here they improved 1 year, but have since seen lower and lower numbers. This is negative. Return on assets went from negative 1.4% down to negative 1.5%. Same thing here, we saw that they improved, but have since seen lower and lower numbers. That is negative. Solidity tells you about a company's financial strength for a long term, and we can see here they went from 68% down to 51.9%. Same trend here. We can see that they fell off a bit, then improved, and then have been seeing lower and lower numbers. This is negative. Balance sheet liquidity tells you about a company's financial strength for the short term, and we can see here they went from 3 down to 1.4, and these numbers improved, but have since seen lower and lower numbers. A bit of fluctuation here, but overall trend is negative. Debt ratio went from 0.47 up to 0.92, and we can see here these numbers have been falling. A bit of fluctuation here, but has of lately seen higher numbers. That is negative. Basically, having a debt ratio of 0.92 is telling you that the company has 0.92 times more debt than equity. These are not high numbers. There are companies out there with even higher numbers, but seeing that this number is growing, that is negative. So guys, we have gone through the income statement, balance sheet, cash flow, key figures. Now over to our key feature, which is the stock analyzer. And basically what the stock analyzer does is that it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. If we go down to the screen, we can see now we don't have any PE data, that is negative. They don't pay out any dividends, which is negative, and the number of outstanding shares have increased, that is negative. Revenue increased over the past 5 years, positive. Profit margin below 15%, negative. Profit decreased over the past 5 years, negative. Current assets are greater than current liabilities, positive. Solidity decreased over the past 5 years, negative. Balance sheet liquidity decreased over the past 5 years, negative. Debt equity ratio increased over the past 5 years, negative, and the total liabilities have grown over the past 5 years, that is negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. And you can have this software along with everything we've gone through for only $10 per month, and you get access to our discussion forum where you'll be able to chat with me along with other members. So make sure to head over to comus.se and become a member today, okay? Thank you. But now let's look at the technical aspect of the stock. So here we have the chart. Let me just lay down some trend lines here, something like that. And let me do one more for the resistance line, something like, let me see here, something like that, right? And we can see, let me change that color to red. Okay. And guys, as you can see, we have been moving within a positive trend channel for quite some time. As of lately, seen that the stock price broke below the trend channel before coming back and reaching this area around here, before having the stock price push the price even market push the price stock even higher back within the channel. It even broke out of that channel before hitting a ceiling right here, and has of lately seen lower and lower numbers. We can see that we are moving in a negative trend channel. Let me do one more here, something like that. So we could see that we are now moving in a negative trend channel. But what have happened lately is that we saw that the Elon Musk, the news came out that Elon Musk have bought a lot of shares in this company, and we saw a gap here over here. And guys, every time you see a gap, just know the fact that you will eventually see that gap get filled up again, meaning that we will eventually see something like this, that the price gets filled up again. And the same thing will happen here, as we saw that the price went up something like this and breaks down, and inverted as same thing. When you see something like that, just know that the gap will eventually get filled up again. So but there is a risk here. Let me just move this one right here. Let me just move that. So and we can see that we are in a very critical area right here. So we could see that the news spreading, getting a lot of attention, and a lot of people coming in and buying the stock, and seeing that the price could reach this area around here. So this would be a critical level, because we could either see the stock price hitting this ceiling and then coming back down and reaching this area around here for a potential buy, and seeing a lot of investors coming back and push the price even higher. Or we could see the stock price break this area and entering the channel again, and then continue its move around here. So we need to be very cautious here. We could see something like seeing that the stock price coming back down. But what I think about the company is that there's not a lot of thing going on in order to push the price even higher. Sure, having Elon Musk as a share owner could bring in a lot of attention and push the price even higher. So if we are to summarize my thoughts about the company, even though I think it's fascinating that Elon Musk is a shareholder now, I will still hesitate to buy the stock. He may bring attention to the platform, which could increase the stock price and create an opportunity for those that are looking to trade the stock. But I want to view it from a different light. Even though in short term we could see a significant price increase, I still see that the business is struggling. I will be more interested to see if the numbers improve. I think the company has a lot of challenges ahead. I like the fact that the revenue have been growing over the last 5 years, but the net income has to improve. And what I'm most excited about is that the fact that the current assets are greater than their total liabilities, but the financial needs work. I think that they need to reduce their administrative and operating costs, convert some of the assets to cash, reduce the rate which the debt is growing, reduce some of the capital expenditure. All these activities would improve their numbers. And I also don't like that they are heavily dependent on their ad revenue. A more diverse product portfolio would be appreciated by the markets. If I would score the company, I would give them a score of 34%. So that's how I would trade the stock. How would you trade the stock? Please let me know in the comment section below. And also let me know if you have any questions or have stocks you want me to look at. And as always, please guys, do your own analysis. And thank you so much for watching. I am truly grateful and appreciate it. And if you have enjoyed this episode, please give me a thumbs up, comment, subscribe. And until next time guys, take care. Bye bye.